Welcome to Total Money Management, where we're covering signals and noise. Back with Tom and Steve. How are you, gents?
Very well. How are you?
Yeah, good, mate.
No wine. Mind you, it's Sunday morning.
It's probably for the best, I
It's
think.
probably a good idea, yeah. Well, actually, yeah, look at this. I'll turn it into...
Is vodka.
What did Jesus do? Turn what?
Water into wine.
Oh, yeah, I'll do that at the end of the show, folks. Wait till the end of the show, folks. Steve will turn the water into wine.
Talk about a complex.
Dear. How are we, gentlemen? Good?
Yeah, it's damn hot at the minute. But
It is. It could be worse. You could be an English cricketer.
I've turned it off.
Go, you good thing.
I've turned it off. What happened yesterday?
They just collapsed in a heap like you Poms normally do.
Yeah, we can't catch a pink ball either by the
I
look
was
of it.
no, it's not too good on the fielding either. Quite frankly, it'll be over today probably.
Yeah, I turned it off. I can't do it anymore.
I know.
Go Aussies!
Don't you love those dual citizens? Right?
Yeah.
You can always win.
Yeah. Just remember a couple of weeks ago when I went, which one do you pick? And you went, you go with the English, mate. You know, home. It's like, right, okay, cool, bro.
But now he's thought about it. Now he's an Australian citizen, and it just makes sense.
Yeah.
Put a lot of work into Australia. No.
Win-win.
Anyway, we're talking about week ending December 5. The ASX has lost a fair bit of its year-to-date gains as well, so we could have a decent run into the end of the year. There hasn't really been a Santa rally in the ASX, although
Not yet.
this week's had a bit of a bounce. But yeah, it's a bit sad.
There's still time.
Still time. But yeah, we're not going to have the returns so far are pretty muted.
Yeah.
So I think it's not going to be a big year unless Santa really delivers, right?
Well, the US is pretty close to all-time highs again.
Yep.
It hasn't done too much exciting, right? Drops a little bit, rises a little bit.
Yeah, it just seems there's a little bit of a trading range, a bit of a sideways market. But, again, if you're investing long term, that doesn't really matter. I must admit, one thing I did look at was the results for Well 2 and Well 3. Well, Well 3 is the equivalent of what we're sort of talking about, the ASX.
Yeah.
And it's done a good there you go. Right on
is
cue.
calling.
Doing my podcast. Here come my kids. No texting, ringing this morning.
I'm going to put it on mute for you.
Good on you, Max Charles. He's a good lad. You know what I do? Every week I write to the kids and I go, I'm going to do my podcast, right? And they're like, okay. And they just ignore me completely.
Let me know when you start so I can call you.
You'll be getting this, Tom, in
Yeah.
a few years.
No.
I think the Well 2 has done really well, particularly emerging markets. I think our average is about 25 or 30. Now he's texted me. Sorry, I forgot you're doing your podcast. Thanks, bro. Anyway, so I think the year-to-date returns have been pretty good compared to the sort of the benchmark.
Well, the S&P's gone sideways. It's, to Tom's point, it's kind of rallied and then dropped and then rallied again. If you look at it over a few months, it's gone zero.
Yeah, it's not doing a lot. How's Biddy, boys?
Oh, it's dropped. But
What's
that's
it now?
okay.
90.
It was at 90 when I checked it.
It got
the
down
other
to
day.
about 87, didn't it?
I haven't looked since it was in the 80s.
It was at 90. Yeah, 89.
And gold is still about 4.2, I think. Is it
Yeah.
4.4 US?
Yeah.
So
gold's at
things are
16.
still. It seems to me things are expensive, but they've sort of plateaued a little bit. Maybe it's just the end of the year stuff. I'm not sure, but it just. I don't know. I think it's obviously not going to be a spectacular year for Australia, but it might be. Hey, if you didn't lose money, that's a win.
Well, I mean, valuations are so high, and we'll cover it. We'll cover my valuations and CAPE ratio towards the end in the lesson, but it's unsurprising that we've had 5 or 10 years really of it just going absolutely skyrocketing.
Yeah.
That now when the market takes a breath, everyone's going, oh, what's going to happen next?
Yeah. There's more. What I'm seeing in the broader picture is there's more doubt creeping in, a bit more of okay, well, how long can this go on? And part of that, or a subset of that, is the AI stuff. They're now it's getting out there more that it's not as good as it's going to be, and AGI is now a decade away. It's not at the end of 2025 like Sam Altman said, like Elon Musk said. It's starting to go, oh, well, now they're admitting it's probably 235, maybe 2040 that they get somewhere closer to it. So that's going to dial the market back a bit. The data centers are starting a bit like, oh, well, where do they get the energy and the water from? Donald Trump's a loose cannon.
Logic setting in a bit. One thing I'm not quite understanding though is you've got experts, even like Howard Marks, saying we haven't had the melt up yet. We haven't had the real spike yet. But I'm looking at these charts going, Jesus, it looks like we've had it. It's gone vertical.
Yeah.
Well, that's why I had put in there from a guy called Mark Spitznagel. Spitznagel is Taleb's partner in a company called Universa, right? And they're a hedge fund. And they're sort of famous for the black swan stuff, right? They make a lot of money when the market blows up. And Spitznagel came out and said, I do expect an 80% crash, but only after a massive euphoric historic blow-off rally. I would argue we're in the middle of that rally right now, not at the end of it. Universa is the most bearish expression of the market there is, and clients use us to be longer the market, which is paradoxical, said Spitznagel, adding he remains bullish for the time being. So this is always the tricky bit when the market's high. Right, because what happens is I've been bearish for a while, but I'm bearish long term, and when I say that I mean a decade. So I'm not saying it's going to crash in the next 6 months. As I've said before, I don't know when it's going to crash, but I'm just telling you the historical returns from this point are really awful. But as Spitznagel says, we can have a 20% rally. And during that 20% rally, what you're doing is going, oh, man, I'm wrong. I'm really wrong. Because it's melting up. But then when it goes down, that's when you go, oh, okay, this could be the opportunity, right?
Yeah.
Then it goes back up again.
But
right?
wouldn't it be in Spitznagel's best interest to not fearmonger and be like, everything's okay?
Well, no, not necessarily. I think their strategy, Spitznagel and Taleb are sort of misunderstood in the way that they approach investing, right? What you do is you either, in the mainstream, you're either bullish or you're bearish, right? That's the way it is. Spitznagel and Taleb are saying, and this is what I've been trying to get across to people, it's not about being bullish or bearish. It's about saying what happens of what are the range of outcomes from here? Now, I could say to you, oh, mate, for the next 3 months, gangbusters, right? But what about 10 years? Oh, look, it's going to be awful, right? And you've got to, most people can't marry those two views in an extended time frame. And what I mean by that is we often get caught in the here and now. Steve's wrong because there's, the market's gone up 10%. It's like, okay, we'll sell all your stocks and get the 10%. No, because it's going to go higher. Okay, cool. Then it crashes and you say, oh, Steve was right. But when you're melting up, what you're doing is going, all those bears are totally wrong.
Yeah.
Well, no, they're just wrong. But again, where you end up is that's what tells you where whether it's no good people saying, oh, Steve's wrong. Oh shit, Steve's right. And it's like, and I lost 50, you lost 50%. That's the sort of, you've got to have that time frame perspective. And what we're trying to coach people to do is say, I know there's a melt up, but I'm not investing for the next 3 months. You can be if you want. But what I'm saying is if you've got a long-term time frame, which most people have, what happens in the next 3 months doesn't mean that much. Because if I said to you, well, Jacob, in 2 years you'll be down 50%, you'd be going, holy Jesus, right? But you don't feel like that because you're in the here and now going, but Steve, it's just gone up 10% in 3 months.
Yeah.
Right?
It's also the awareness, right, to know where you're at in the cycle going, cool, okay, I'm happy to, take advantage of the run while it's here, but I'm also conscious that, it's probably going to run out of steam.
Yeah, and I should rebalance more.
Yeah.
Right? Or, I'll stay in cash longer or something like that.
Or the portfolio is set up in a way to expect an 80% crash and then rebalance as and when that happens.
What Spitznagel does, which is really clever, and we're gonna talk about this further in our hedging hierarchy, is if you think over time, what you want to do is say, okay, the stock market will, in 10 years or in 20 years, will probably be higher, right? We've looked at every 10 and 20-year period and it's ended up higher, right? Varying degrees, but it's higher. Okay, well, I will be long a part of my portfolio for that. But there will be a lot of volatility. Oh, okay, well, I need a mechanism which hedges that market, right? So if it crashes, I don't lose 50%, I lose 15%. And that's really important because the more you lose, the longer it takes to get back. Not someone else's kids ringing. And so, you know, it's better to say, I started with 100,000, I'm now at 85 at the bottom, rather than saying, I started at 100,000 and I'm now at 50.
Yeah. Yeah, the as much as you can possibly mute the volatility to the downside.
Yes.
That's how you create exponential gains long term.
Exactly. That's what Spitznagel's doing. What Spitznagel's doing is saying, I use put options to hedge the really big events. Now, if the market falls 5%, I don't care.
Doesn't matter.
But if it falls 50, that's when you should be concerned. Oh, okay, so there's only a 100 to 1 chance it falls 50%. Okay, but what if it does? Oh, man, that's really awful. Okay, that's why I'm going to take out a put option for insurance. If it falls 50%, my 100,000 doesn't go down to 50, it goes down to 85 because I bought a put option which makes me, 400%, and I sell the put option and then put it back into the portfolio.
Yeah, and carry on.
Right? That's the way they do it. And it's when you do it dynamically adjusted like they do, i.e. every week they move their put options about and they buy and sell and that sort of stuff. That's how, these guys make 1,000% returns, right? When the market blows up.
Yeah.
Right. And that protects their long portfolio. And what Spitznagel is saying is what that does is over the long term, like you said, Jacob, you get a higher geometric return. Right. And that's the key to it. And that's what we keep saying is you've got to focus on not losing money. Right. Not making money, because the less you lose, the more you make. Right. Yeah. The more you try and shoot for the stars, the more you're unlikely to get there.
Yeah, the likelihood's high that you eat shit. The worst thing you can do for your portfolio is eat shit.
Yeah, exactly. And loads of it when the cape is at 40, right? You're going to be eating a lot of it.
A lot of shit.
Right.
What's next?
Hell of a metaphor.
Yeah.
That's
it's
my
too
cap.
early for that. Yeah.
Don't eat shit.
Yeah, that's a good idea. No, you're definitely getting more and more people come out of the woodworks talking about, I think something really, really bad could happen here.
Yeah.
We've obviously been banging on about that for years.
Yeah. Well,
every single week, actually.
Three bears.
the three bears.
But yeah, just a reminder, right? .com, the NASDAQ lost 83%.
Yep.
And
you forget
can
that,
get weird.
right? See, that's 25 years ago. Half of the investors are now wouldn't even be cognizant of the GFC or the .com bubble. Right, you guys were 5,
6,
right? But and that's what I mean. It's really important, right? Because that's why old guys like me say, "Listen, you should be careful because I've been through these things, and it's really unpleasant, right? It's really seriously unpleasant, but you just can't envisage it, right? Because it's just, the place can be rocky and stuff, but you just can't see, you just can't get up one morning and go, yeah, I got a real vibe. We're going to hit down 60. Right?
Well, the closest we've come to it is the crash through COVID, and that obviously didn't last very long.
Well, it lasted about a month.
Yeah, but those few weeks were quite scary.
Absolutely. Well, it went down 30%.
Yeah.
But see, then it rebounded 30% the next month.
Yeah, but that's also not that usual either. Like if you
absolutely.
think about the .com or the
absolutely.
It's been weird for years.
A little bit, Tom. It depends. Look, you'd be surprised how many months there are when it loses 20%, right? And I can tell you, because I show it in part of the Well One strategy, look at all the years when it does that, the CAPE ratio is really high, right? 1929, 33, there's a lot of that events take place. 87, right, where it went down 25% in a day. 2007 or 2008, I think. But what I'm saying is, again, if you know those statistics,
And what they're linked to.
yes, and market history, you wouldn't be sitting here saying, "Oh, well, these guys are wrong." You know, now could we be wrong? Absolutely, but according to history, there's nothing here that says we're wrong because we've got AI. All right, well, we had the internet. And before that, it was the Nifty 50. And in the Great Depression, it was, the stock market's reached a permanent plateau. So what I'm saying is every bubble, there's always some sort of reason why it's different. And it never turns out to be different because it by its own logic, even if I said to you, look, AI is going to be here next year, well, it's already priced in. So, you know what I mean? Like it's more likely there's a failure rather than a success, because what everyone has done is with NVIDIA and OpenAI and all those places, they're assuming success. And like, again, what Spitznagel is good at is saying, yeah, but what if we get a black swan? Oh, well, then it's a disaster. Okay, I'm just going to put a little money on the black swan.
Yeah.
Because your expected return is like, 1,000%.
Yeah.
Okay, and I lost 10 grand. But if it hits off, they make millions.
Yeah.
Right. So that's the sort of thing you have to think about when you're investing, right? Is that arc or that range of returns, and not a lot of people do that because, and we'll talk a bit more about the lesson of the week, that sort of stuff, right?
Well, I wanted to talk about the macro moments slightly. So Venezuela, I have no idea what's happening in Venezuela, and I can almost guarantee that no one listening knows what's happening in Venezuela. So can you?
It's getting hot, mate.
Well,
It's getting hot.
It's really hot.
the argument is Donald Trump has gone into Venezuela or has sent down, 42 ships and, 5 brigades and a real overkill moment to take on Venezuela, right? Now, the argument is Trump is saying it's because of the drug dealers, right? The drugs coming from Venezuela into America. The valid argument is, well, yeah, kind of, but the drugs are really fentanyl and they're coming from Mexico they're coming from China via Mexico, right? So what are you doing in Venezuela? Okay, so there's one question mark. The second thing that's rather fortuitous is Venezuela discovered an absolute shitload of oil, right? So suddenly the Americans are interested in Venezuela, right? It's a bit like we're going into Iraq to free up the people. It's oh, you're not. You're going there because they got the big oil reserves. It's like, well, that's a bonus, right? So there's that stuff. The third argument, geopolitical argument, is Venezuela. If the national security policy came out for Trump on Friday, right? And I'll detail more of that in future, but. What there's an old doctrine called the Monroe Doctrine, and what that was simply the West, America saying, this portion of the world is us, right? Don't come into this portion of the world, we'll blow shit out of you, right? So don't come into Canada, don't come into Mexico, don't come into South America, right? This is the Cuban Missile Crisis, right? Don't go, you commies, thinking you're going to put missiles in Cuba, right? Because it's not going to happen, right? So that's. When you look at America's trade, a lot of it comes through the south there. So that Venezuela is part of a strategic area where in order to protect their trade routes, what they've got to do is say, well, we've got to make sure Venezuela's on side. Now, Maduro is cozying up to China and Russia, right? Well, that invites the Americans to go, listen, sport, you're playing a dangerous game here. Right? So Maduro also had an election where he didn't win the vote, but he just said, well, I'm staying around. So Biden didn't say, well, no, you're not, because we're going to come in and get you because there's an election on.
I like this house.
Yeah, so what they're now doing is Maduro apparently has said, okay, I want $200 million in cash. I want safe passage for me and my family, and we're going to set up in United Arab Emirates, right? So it's a little bit like, listen, we either walk in here and kill you, or you just shut up, take the money and get out of there, and we're going to be running the show, right? So it's a little bit, America did this with Chile in the 70s, right? The Chileans had an election and they voted in the communists, right? And the CIA went, no, you voted badly. So they went in and killed the president.
Yeah, right.
And went, okay, now you're going to be capitalists, right? So this is what...
Allegedly or actually?
No, actually.
Yeah, right.
Oh, no. And so, but see, we're going back to those days. That's what I'm trying to say to people. We're going back to those days where America will use its military force
Totalitarian.
to basically say to people, no, you're in our sphere of influence and you are not talking to the Chinese, right? And if you want to, that's fine. We're going to come in and bomb the shit out of you, right? And, I'm serious. And that's what Russia is doing with Ukraine, right? That's, we need Ukraine as a buffer. The Americans are saying, yeah, we need South America as a buffer. And China is saying we need Taiwan as a buffer. That's what they're doing, right? And this is why I say deglobalization is important, because what they're doing is they're dividing up the world. And the argument at the moment is, where the hell does Europe stand?
Yeah, because there's, how many? 28 to 50 different countries.
Yeah. There's like 28 of them, and that's why the next point, right? Russia gets heavy with Europe. Putin said, well, if Europe wants a war, Europe didn't say that, but Putin's saying, well, if they want a war, we're ready.
50 countries in Europe.
Yeah, and there's about 27 in the EU sort of thing. So but the point being, the world is being divided up. And, Trump on Friday made a trade relationship with the Democratic Republic of Congo. Find that on a map without being labelled. And there was one other, tin pot African country. Now, why would he do that? Because they've got the rare earths.
Yeah.
Right? And he's saying we need the rare earths. So Brazil has got a lot of rare earths. So, this is what's going on. What they're doing is they're all scrambling for the resources for a post-globalised world, right? Oil, energy, commodities, right? All that sort of stuff.
I can't wait for oil to I can wait for it to go to $100 a barrel, but my portfolio can't wait for it to go to $100 a barrel.
Yeah, well, keep your eye on natural gas too.
Yeah.
Because as I said, I think the one area where we talked about in the 4 Cs, climate change, I think that's dead in the water.
Oh, it's been kicked in the ass by almost every country.
Yeah.
Now. Even the UK is
I
tracking
think
back
there's less and less of that stuff. The more and more countries I'm seeing that just go, yeah, righto, okay, sure, yeah, net zero 250, yeah, cool, yeah, we're in it. Anyway, we've ordered a couple of oil rigs, and I mean, real politic beats out ideology all the time.
Yeah.
I'm not going to sit in my lounge room and go, I feel really
Well,
good in this 35-degree heat because I can't have air conditioning because I'm saving the universe. It's like bullshit.
I was looking at a chart, like a long-term chart of all the countries that are trying to achieve net zero and their carbon emissions.
No one's going to get close.
And it's all like to be fair, most countries are tracking down over the last 20 years or so, and then China's gone. So everything that China has put back has just offset.
Yeah, nullified
every
everybody
country.
else's
So everyone's like, what the?
Yeah.
Why are we doing this?
Yeah. It is.
Anyway, Aussie economy, credit growth still gone through the nose. It's scary. No one can afford a house apart from investors. Let's move on.
People already have houses.
Yeah. Well, I put in there a fund manager's view just to let people know the reason why we talk about property. We're not property experts, but what I'm doing is saying everything is interconnected. Property market has now become a market not about property, but about speculation, right? So it takes on a different vibe.
It's the NVIDIA of Australia.
Well, what's happened is we've got into a speculative phase in property. I think it's getting near the top, right? And so what I'm saying is that's going to affect stock market investing. Because if you, for example, Jacob said, oh, Steve, my negatively geared property is now underwater and I can't really sell it and go down $100,000, so I'm going to hang on to it and lose $200 a week. My argument is, well, that's cool, but that's $200 you're not going to put in the stock market.
Or the economy.
Yeah. Right? So that's where we may have a very, very long, unpleasant decline a la Japan. right? Because there's so much debt in the property market that there's, again, it gets back to it's like CAPE, right? Again, people are going, Steve, Brisbane went up 13%. And it's like, yeah, do you think it's going to go up 13% every year? Right? So even if you say, let's say 10%,
Yep.
right? Or 7, let's say 7, right? Property prices rise 7% per year. Okay, so that means in 10 years, they're going to be double. So that means in 10 years, the average Queensland property, not Brisbane, right? The average Queensland property is going to be 2.2 million.
Yeah, obviously.
Yeah. So how would you buy that? You need wages to double
Well, that's what I was going to say.
even to keep up.
And they
So
haven't doubled the
Like
last
they
time.
have been, right?
No,
For the
yeah.
last-
But that's why I'm saying all we're doing is loading up on more and more debt, right? So all you have to do is you do a discounted cash flow, extrapolate it out and go, I'm sorry, this is impossible. Unless,
100-year mortgages.
well, but it still makes it, you've still got the same problem.
But there's always, just to play devil's advocate, the prices that we have now were, if you asked someone 20 years ago or 30 years ago, they would say that this is impossible as well.
Yeah. Well, yes and no, Jacob, because back then we didn't have a lot of debt. You see, this is what I'm trying to get at. Thanks, Tom. This is what I'm trying to get across to people about debt drives the economy, right? And people really need to get that. I know I harp on about it, but I harp on about it because that's how you get economic growth. Somebody has to borrow to put more money in the economy. It's either the government. Well, no, Albo is now talking about trying to bloody well save money. It's got to be the private sector with investing. Well, no, they're not investing. Why? Because our consumption levels are actually quite low, right? And why is that? Because everybody's speculating in property, right? The worst people you want to borrow money are consumers, right? Because they're not
Spend it on shit.
Well, they're not investing,
Yeah.
right? People think they're investing, but they're not investing. In aggregate, not everybody can win out of the property market, right? So that's why you want business to invest. But for business to invest, you have to say, well, mate, you need to build some more JB Hi-Fis because, people are really, the wages are rising and everyone wants AirPods and, iPhones and TVs and stuff. And everyone goes, oh, Jesus, that's good. We'll build more shops.
Yeah. Or to make it a little bit more realistic, build more places that build homes. Or
Yes. Yeah.
More oil things to pump things out of the ground.
Yep. And at the moment, that's why I keep saying the economy this week came out and, the data was economic growth is about 2%,
And what's inflation at?
3.8. Right. So
Yes,
we're
awesome.
going, we're
Just
going
dying
back.
a slow death.
And what are wages going at?
Yeah.
Yeah, negative.
This is what I mean. So you look at it and go, well, how can house prices continue to rise? Simple. The banks will continue to lend, right? And that's why, again, APRA has said to the banks, listen, you guys got to dial it back a bit on the investor stuff, right?
Yeah.
Because, the investors are going nuts.
Well, what? Martin Conlon came out, reckons that the Australian property market's a Ponzi scheme.
Yeah. Well, it is.
It is, yeah.
It is. See, again, the Ponzi scheme is I'm losing money, but I'm going to sell it to some other moron who's going to pay more for it. Okay, cool. Well, that works until someone says, we're not buying it. Then you're in trouble because you're the last one holding the Ponzi.
Last one holding the bag. Wages grew at 3.4% for the record.
Yeah. Private sector's a little bit better.
Private's 3.2, public's 3.8.
Right, okay.
So 3.4 average.
See, that's not strong enough.
No.
When you look at the investor commitments for the September quarter were 57 57 billion. That's from the June quarter to the September quarter, there was a 13.5% increase in investor loans. Jesus Christ, how many people out there have got multiple properties?
Oh, this is interesting. So,
A lot.
6.4. Owner occupier increased by 2%. First home buyers increased by 2.3%. And, non 2.8 and investor 13.6.
That's what I mean. Investors have just absolutely ploughed into the market. Now, here's what I think's going on. I think investors are saying, I'm going to get in now, and what's going to happen is the prices are going to rise, and I'm going to sell to someone who's got a 5% deposit, or like you say, Tom, someone who's got a bloody 50-year mortgage, right? But all I'm trying to point out to folks individually is just make sure you're not holding the bag, because, the higher these things go, the more they're going to fall, believe me. This shit's not going to go on forever, and the demographics even over the next 20 years is terrible, right? So even on a demographic basis, property, you're going to have a lot of empty properties, right? So this is what the US is already experiencing. Now, this week, the US came out and said, we're going to relax the lending standards, right? This is what I say happens every time. The banks go, dude, we need to lend some more money. Oh, shit, has Tom got any money? He's got a cat. Yeah, that'll do. Right, lower the lending standards, and we'll give Tom $500,000 to buy a property, right? And this is what goes on. Seriously,
has no one ever watched The Big Short? Seriously.
But but the problem is, Jacob, what you get is you get a heap of experts saying, "Oh no, we've dealt with that," and that's why I'm saying, what's happening in the non-bank financial institutions, right? The sort of shadow banking. Nobody's paying attention. Right? And I'm telling you, there's a shitload of trouble coming, right? Because they're not regulated, right? So in other words, they've got a free hit. And that's why I said last week when APRA came out and said, right, you banks have got to stop this, DTI greater than 6 to investors. The investors went, oh, cool, we'll just go to the non-bank financials and they'll get us a loan.
Yeah.
So APRA's hit these people with a feather, right? And again, what they're doing is they look at the shadow banking and go, it's only small and it's not contagion. And what we learnt in the GFC was, yes, it is contagion. So in other words, everything's connected. When that little bit falls off, guess what? It ripples out and gets everybody else.
Yeah.
Right? Through the securitization, blah, blah, blah. But anyway.
Everything's tied up to each other.
Yeah, right. That's what you've got to realise these days. That's why, gold's high, property's high, stocks are high, bloody Bitcoin's high, right? Everything's high. And it's because they're all connected and they've all got this huge forward momentum, right? But that momentum falls down at some point.
Yeah. Yeah, good. Anyway, let's finish up on the lesson of the week. You've got something here on... Well, this is something we teach in... Which one? Well 2?
Yeah.
I think it's Well 2.
Yeah.
And what we're essentially saying, if you're not subscribed to Signals and Noise newsletter, go to the website. It's free, and you can actually see what we're looking at. But this is a chart essentially color-coded by dark green, light green, yellow, and red, and how high the CAPE ratio was at any one time, and then the future forecasted. Actual returns.
Yeah.
Based on what the CAPE ratio was at that time. And you can see when the CAPE ratio is anywhere from 5 to 10 or even 10 to 15, the future forecasted returns or future returns are 15 to 20%. And it's color-coded in a way so you can see when the CAPE ratio is down to between 20 and 45, i.e., where we are now, the returns are all minus.
Not all minus.
There's a few that are 11, 12.
Yeah, they're the outliers.
Yeah.
So what I'm trying to get across to people is, again, what we were talking about at the start of this, right? Which is if the CAPE's at 40, right, 100 divided by 40, 2.5. Oh, you're going to get 2.5. Well, no, you might get 1.2. You might get 4.6.
Yeah.
But the average will be roughly about 2.5.
Yeah. You might get 10 this year, 12 next year, and then negative.
Perfect, right? Which is generally, Tom, what happens. You get a melt up, you get a 25% year, and then you get smashed.
Yeah.
Right? So in just on that point, Tom, 95 to 2000, the US market doubled, and then it halved. Then it doubled, and then it halved to 2009, right? So what I'm trying to get across to there again is, like what Spitznagel said, right? What are the range of possibilities, right? Well, from a CAPE of 40, your range is somewhere like minus 50% over 10 years to maybe plus 20. Okay, what's the odds of getting plus 20? Oh, look at the chart. Not a lot, actually. Okay, what's my chances of getting -5 to -2 to -5 per year? Oh, yeah, really high, right? So, again, you've got to think in the range, like the probability distribution,
Yes.
right? And what if you dig a little bit deeper, like we sort of try to teach people, dig a little bit deeper to go, okay, every time the Cape's at 40, you've lost money. Okay, should I invest money? Well, okay, best of luck, because, on average, you're going to lose. Why don't you just go to Brazil where the Cape is 7? What does that mean? Well, over a decade, you'll probably do all right.
Yeah.
Oh, okay. What about America? No, because the Cape's at 40. Right? So that's the distinction you've got to make. Not simply saying, I'll probably get, which is this bullshit about the average, right? Oh, you'll probably get, 8. It's like, no, you won't. You're not going to get anywhere near 8, right? Because you get either +16 or 0,
Yeah.
right? There's 8. And at a Cape of 40, dude, you're probably going to get 0.
There's a lot of zeros.
Right? Considering we've had a 16-year bull market, right? Where the Cape's gone from 12 to now at 40. So that's why I look at it and go, I have zero FOMO, right? Zero FOMO, because I'm just looking at it going, next 6 months it could go up 20%. I have no idea, but I'm not investing in well too for the next 6 months,
No.
right?
And you've also, you can sit there and go, I've made some really healthy returns for
Yeah.
a long period of time and I want to hold on to them.
Well, even this year is a good year. We've had a good year this year.
Yeah.
But it's like I say to people, I'm not 85% invested,
No.
right? I'm probably about half, maybe a little below half. Now, it's still all right, but it's not like, oh my God, like you made $45 million, right? Because it would be silly to say the Cape's at 40, but I'm going to be 85% invested or 90% invested, right?
Yeah, we eat our own cake here at TMM.
Yes. And that's what we're trying to teach people, right? We're trying to teach them to think over time. Don't get lost in that emotion of, oh man, like Tom's kicking, 30% a year and I'm only doing 6. And it's like, yeah, but Tom doesn't know that he's lining up for a -50. At least you know that there's a range of outcomes.
Yeah.
Right?
Cool. Well, I think that wraps it up, fellas. Is there anything else you want to add?
No, I don't think so. Just the fact that we're above 40 Cape is diabolical.
Just hang in there, folks.
The highest ever was 44 in 1999.
Yeah.
Yep.
We might
Japan reached 100.
well, that's
Yikes.
awesome. It means we've got such a long run.
That's absolutely. And then you got 30 years of going nowhere.
Yeah.
Well, you didn't go nowhere. You went backwards,
Yeah,
right?
a lot.
So,
Well, we've got a few Christmas specials coming up. We've got the hierarchy of hedging. Steve's writing his book, which will be out next year, not before Christmas. Let's not put that much pressure on him. And what else we got coming up? We're going to do a Sydney trip in January or February.
Melbourne
will come up at some point. But we just want to connect with some members. So if you're around,
Please come and see us.
come and say good day.
And we're available to drink copious amounts of red wine.
Absolutely.
But don't let us influence you on that.
Drink responsibly.
We just talk a lot more when we've got red wine.
All right. Thanks, gents. See you next
Cheers,
week.
Thank
folks.
you.
This podcast does not provide financial advice.